Hi all, Jason O'Shaughnessy, 360 Partners Finance. I hope you're all safe considering the current circumstances. Now, today I thought we'd do a quick video on fixed rate mortgages and what you're really paying for when you're fixing a mortgage, and that's a fee to do so. Because really the banks are trying to achieve two things when you're fixing your mortgage. And the first thing is, well, keep you as a customer because there's usually a break cost when you want to move from a fixed rate mortgage. And secondly, actually they're earning income or a margin by you entering into a fixed rate mortgage that you don't really know that you're paying. So you've probably all seen the advertising blitzes and the current marketing on fixed rate mortgages at the moment. You're seeing that they're actually probably about 0.5% cheaper from their variable rate at the moment. And on a $500,000 mortgage, which is probably the average mortgage in Melbourne these days, that's an equated savings of upwards of $2,500 that you're saving by fixing in your mortgage at 2 or 3 year money. Sounds too good to be true? Well, maybe not. But there are some things that you do need to consider when you're looking at these fixed rate mortgages. The first is that the reason that the fixed rate mortgages are so cheap is because that's where the market is expecting, the interest rates to be in the next 2 or 3 years. So the banks are borrowing 2 and 3 year money at that cost and then passing it on to you. What you don't know is that the banks, when they borrow it for cheaper, will actually then put in an additional margin for you to fix in at that rate. So all things being equal, you expect the variable rates to move down there, or that's what the market says, but you fix it in now, but with an extra margin. So that's not necessarily a bad thing. One way I like to look at fixed rate mortgages is an insurance policy. So you pay your insurer $1,500 a year to insure your house. You do so willingly. You don't expect your house to burn down, but it might. So every year you pay $1,500. Looking at a fixed rate mortgage it's almost the same concept, right? You're fixing your mortgage. In doing so, you're paying a fee because the market's saying that the interest rates are going to go down there, but it's an insurance policy in case the rates do go up. Another prudential way to look at it is that if you've got personal circumstances where you can't afford for the interest rates to go up, or you might in fact be going on non-paid paternity leave, where being able to fix in those costs are really quite important to you right now. Well, paying an additional fee or a hidden fee to do so might not necessarily be a bad idea in your circumstances. So the really important thing here to understand when we're looking at fixed rate mortgages is that realistically, all things being equal, your variable interest rates are heading that way. And staying variable, well, most likely it's going to be cheaper to do so because the variable rates will be down there anyway, and you don't have to pay that execution margin that the banks will be putting in on fixed rate mortgages. But of course, everyone's financial circumstances are different. So you should really be having a look and talking to your financial advisor about what is suitable for you. All right, well, of course, if you've got any more questions about this, feel free to reach out to me or any of the other 360 Partners team. Please do stay safe, and I'm sure we'll all catch up soon. And not until then, we'll see you soon for a new video. Cheers.